Should you pay off your mortgage or keep it and invest it? Hey everyone, I'm Andrew. I am a CFA charter holder and CFP professional who's been working in finance for, I don't know, decade and a half-ish. And typically work with people who have complex situations and very high net worth investors. And I make these videos to hopefully bring some of those learnings from all of those reps I've gotten over the last several years and bring them to you. So today, should you be paying off your mortgage? It's a question. I don't care if someone has $100,000 net worth or if somebody has $10 million net worth. I swear I get it once a week. And so I thought it'd be worth talking about it today. I'm going to give you a mathematical answer. I'm going to give you a philosophical answer. Mathematically, interest rates have come up. In 2022, the Federal Reserve started raising them. And if you look at, 10-year Treasury bonds, they were paying in the high ones at one point. Now they're in the fours. Okay. So let's say you have 10 years left on your mortgage and your mortgage is at 2.5%. I can make money in the mid fours on a Treasury bond. I can pay money out in the mid twos on the mortgage. And by the way, depending on my tax situation, I get to deduct that interest as well if I'm over the standard deduction and I itemize. And I pay tax on the interest with the Treasury bond, but you're making a spread, right? So what is that? In finance, we call that arbitrage. I've bought a risk-free investment and I'm paying out money to a creditor, but the spread is in my favor, not the creditor's favor. That's arbitrage. It's what a lot of hedge funds do, but they do it with complex investments. So mathematically, you should do that. You're making money every month by having debt. Okay. So let's pull that out a bit. What about if it's 4.25? Now you're close to parity. If you can still deduct it, it may make sense, but it doesn't make a whole lot of sense anymore. And here's something that a lot of financial advisors aren't going to tell you. Okay. When you pay off debt, have a probability distribution, right? You remember that from business school for those of you that went to business school or did stats? Your distribution has no tails. There's no really good outcomes over here. There's no really bad outcomes over here. It just is what it is. Every time I pay my mortgage down at 4%, I'm getting a 4% return on my money. However, if I buy a 10-year Treasury bond, in the meantime, interest rates may go down. Well, there's a distribution. That means my bond value went up. I can do a video on that in the future. Bonds tend to confuse a lot of people. If interest rates go up, now my bond's not worth as much. Well, the value goes down. There's a distribution of outcomes there. And then let's broaden it out to stocks. If I assume stocks are going to do 8 to 10% over a long period of time, my mortgage is at 4 or 5. There have been 10-year periods in the stock market that were flat. Not very many, but 2000 to 2009 was one of them. They call it the lost decade. So you have to accept that there's risk with that distribution, okay? When you pay down your mortgage, there's no distribution. A lot of financial advisors don't like to mention that because guess what? They get paid on assets. Is there an incentive for you to pay off your mortgage or for them to keep the assets? I'll leave you to figure that one out. So my general recommendation to people is if you're 3 and under, you should probably keep your mortgage. If you're 3.5, really 4 to 5%, in some respects, I could care less either way. If you're a little more risk tolerant, you're probably going to be better off keeping the mortgage and investing, especially if you're more equity heavy, 8, 9 times out of 10, when you wake up 10 years later, you're going to have more money. If you're above 5, 5.5, if you're in the current environment where it's 6 or 7, pay that sucker down. Okay. Unless you have liquidity needs for something else that you need to be saving for, just go ahead and pay it down. It's in your best interest. Most likely, big asterisk disclaimer, this is education, not advice. Now, that's all math. Philosophically, if it is hard for you to put your head on the pillow at night and sleep because you have a mortgage, because you owe debt to somebody, and you're in a good financial position, 10 times out of 10, I recommend paying out the mortgage. Why? If your retirement plan shows a 99% probability of success with a mortgage and without a mortgage, what do I care? I mean, honestly, you're going to be okay either way. Why would we not want you to go into retirement confident, not having to have the anxiety about all of those types of things, right? So that's why I say there's a mathematical answer and then there's a philosophical answer. And philosophically, if you're opposed to debt and you're already in a position where you can pay that nut off and still be okay, go for it. You will feel freedom more than the rest of us would. Some of us have high debt tolerance. Some of us don't. Not right or wrong. That's just your makeup. And so when I get asked, should I pay off my mortgage or not? The answer, as with so many other things in finance, it depends. But I hope this gives you a framework for looking at it mathematically of, hey, if you're under 3.5, you should probably keep it. If you're in that 4 to 5 range, you could keep or pay it off. But if you're in that 6.5, 7 range, you should probably be paying it off. But philosophically, if it will bug you and you're in a position where your retirement plan is fine either way, pay the sucker off. I hope that gives you a framework for looking at it without some of the BS that gets associated sometimes. So until next time, thanks everyone. Appreciate it.